Hello and welcome to Multifamily Elevated. My name's Suzanne Hopson, and I am super excited to talk to you about vision, people, and execution, and how you can utilize this information to elevate you and your team and your experience in multifamily. Brought to you by the Multifamily Media Network, giving you the latest and greatest news and content across our multifamily sector. So let's jump in. Enjoy this episode of Multifamily Elevated and enjoy the climb. Hello and welcome to another episode of Multifamily Elevated. We are very excited to have a different guest today than maybe the norm, someone that I have met just recently who is in a different part of real estate than our typical audience, but has a lot in common with some of what our audience has gone through. And so I'm really excited to have you here, Rob. So Rob Seldin, welcome to you. Could you please tell our audience a little bit about yourself?
Sure. Thank you, Suzanne. I appreciate the opportunity to sit with you today. I'm the managing principal of a development company here in the Washington, D.C. area called Madison Highland. It was sort of the strategic merger between really two organizations, Madison Marquette, which is a large multinational development company, and our company, which was Highland Square Holdings, which was a small local firm. And we are largely focused on, I would say, office to residential conversions here in the DC area, but with a specific twist on focusing on what we would call our live work platform, which is really about how do we make buildings more responsive to emerging consumer demand, and in ways that really focus on the customer more so than focusing on something else, which we seem to see a lot of in the real estate business. So we are extraordinarily customer focused, trying to deliver what we would describe as core assets with really opportunistic returns, but only value add plus risk. And we've been doing it here for about 10 years now. So we have a little bit of a head start on, I think, a lot of the things that people are beginning to realize and questions that they're asking about that space.
Thank you for that. And that's what I found so fascinating in our conversation that we had a few months back, was just that you were doing something that I really hadn't heard much about. It wasn't really in the vernacular, in the ecosystem of where I have been having conversations. And so what just a neat thing. I know that, I've heard a lot about the commercial space conversions from COVID and the attempt to really, manage that space well and basically get out of bad situations because commercial was not doing well during that time. But to think that this was really orchestrated outside of that, and, this thought was going on before then, and now is actually growing into, something really big in your area is just fascinating. I thought people would find that fascinating as well. So let's take a step back, if we could, and just talk a little bit about where you came from and how you fell into this business. Like, how did you get started doing this?
Well, that's a good question. I'm not sure it was as strategic as it should have been, but it's over time developed into a strategy. For a long time, I was sort of employed by large organizations. I was the local head of development for a large real estate investment trust, and then after that business was sold, I started a business with a local investor, and he had been really in the hotel business for a long time and was looking to transition back into multifamily as a vehicle for intergenerational wealth transfer, as he was sort of, let's just say, an older gentleman. And he was beginning to think in terms of what comes next. So as we began going into the apartment business, one of the things that he quickly realized is it takes a very long time to get from start to finish in high barrier markets. You're going through a lengthy entitlement process. You're going through a lengthy design and permitting process. It takes a long time to build before you ever make any money. And as he was of a certain age, he was focused on how do I make money faster? So at the time it was, well, the best thing to do is to try to buy existing, but how do you create any value buying anything existing, because everything seems like it's overvalued. So at the time, the DC area was experiencing a tremendous increase in office vacancy. This was mid 2010s. And that was largely fueled. I mean, if you think about it, in 2010, the DC area was the safest office market in the country. DC had the highest office rents in the United States, and it had the lowest vacancy. And then during the period of 2010 to 2019, office vacancy in this region rose by over 30 million square feet at a time when we were gaining 450,000 jobs. So as office vacancy was rising, job growth was expanding rapidly, and that had never happened before. And so the question was really what was fueling that? And the short answer was the federal government. That I know there's a lot of talk now about what changes are happening in the government, and when should people come to the office and when shouldn't they? But people in the federal government stopped going to the office a long time before COVID. In fact, it was in 2010 that the federal government passed the Federal Telework Employment Act. And that allowed pretty much all federal employees to telework if they didn't have some security reason for needing to be in the office. And as you might imagine, that was a very popular program. So as a result, a lot of people decided that they would follow suit. But the bigger question is, why could they do that? And it really was that, if you think about it on a macro scale, the federal government is the largest information processing enterprise in the world. And if an office building is really just a machine for temporarily storing people and permanently storing information for processing. Well, if you can process information anywhere with mobile telecommunications, you don't need to go to a building to do it. And so interestingly, the federal government was the first to recognize that of all the major employers in the country. Usually the government's the last to know. In this instance, they were the first to know. And then once they began doing that, a lot of their ancillary service providers began following suit. And as they say, the rest is history. So our question was, if there's a tremendous amount of office vacancy, what can you do with these buildings? And from our perspective, office was always the primacy asset type. They were better buildings than you could afford typically to make into apartments. But if you could buy them, these really high quality physical plants at bargain basement prices with taller ceilings and bigger windows and in the best locations with twice as much parking, you could make them fairly simply into really high quality residential units. So we began doing that in around 2015 and have been doing it ever since.
Wow. That's a really cool story. I know we did talk about some barriers and some obstacles that you had to overcome in doing this. Can you talk a little bit about what those obstacles were and how you managed to overcome them? And I know it goes beyond, obviously, the footprint that you're in now in terms of your growth and what you're looking to do next. But it seemed like that might have been a difficult process, or there was something really difficult about it and, expanding that out. Can you talk a little bit about that?
Sure. I would say, interestingly, when we first got started doing it, it was much easier than it probably is now. Before, everybody had to have a house view on office conversions. Back then, it was, hey, we have this great building, high-rise construction, 600 underground parking spaces. We could buy it for $20 million, and we could convert it into the highest quality multifamily 3 miles from the Pentagon for about $250,000 a unit in about a year. So everybody seemed to be on board with that. And so when we first got started, that was really what we were finding, was that everybody was like, oh, wow, they can just be better apartments and you can do it faster and less expensively. That seems like a no-brainer. So we got much better debt terms than we would have normally gotten doing a ground up. And we were delivering a much higher quality product for much less money, much faster than anything we had ever done before. What we found, interestingly, is as the, let's just say, office contagion has expanded into other parts of the country, and as people began looking at it in the traditional ways that real estate has been financed of late, which is largely through private equity. Private equity has very discrete buckets of capital that they allocate for very discrete strategies. And up until recently, nobody had a specific strategy geared around buying assets that were designed as one thing and redeploying them in another manner. And so it was a very difficult thing to marry, to say, we want to buy this building that was designed to be one thing and turn it into something better than it otherwise could have been, just because the perceived risk, I think, from the capital provider was greater in their mind than the potential reward. Now, in reality, that's not true at all. And in a lot of respects, that actually creates a much better opportunity set for us, because the fewer groups that actually want to do this, the more artificially devalued the highest quality physical plants become. And it just makes it that much more advantageous for people who really have the knowledge and skill how to transition them. So we don't want to tell too many people that it's not as hard as they think, and that the outcomes are actually a lot better than they ever could have imagined, because then it's just going to make our process more expensive.
Yeah, well, no one's going to know after this goes live. But I think one of the things we also talked about on the phone, which I thought was really interesting, was this concept of, yeah, you can share this information. It's really about the execution and people being able to do this, even with it all being set up. And as a leader and as someone that has been very successful in this, I'd love to hear your take on what it's like to work with teams, and as a leader with those teams. How do you get them to execute? What were some of the struggles that you had with other people? Because I know when your team's really small, it's a little bit easier. I mean, my startup friends would probably argue with me, but I would just be interested in some of your leadership experience and some of the things that you had to overcome with people.
Well, that's a good question. The real estate business is I guess all businesses are really at their core people businesses, and you're trying to execute and create something that does not yet exist, and you are trying to do that with a people of a variety of skill sets and a variety of temperaments and a variety of, let's just say, desire. And how do you marry all of those things or orchestrate them into the outcome that you want? It's not really very easy. And in fact, if you follow the normative playbook, I would say that the system as it's been created is set up to make you fail.
Explain more about that. Yeah. Let's dig into that a little bit.
Yeah, sure. So I think if you're the way that the world of the product creator has evolved has been in response to the stimulus from the private equity world. So insofar as private equity has money for specific strategies, the people who are on the product creation side have created frameworks that fill those buckets. And they will typically have a person who is doing the land acquisition, a person who's doing the design management, a person who's doing the entitlements, a person who's doing the transition to construction, a person who's doing the construction management, and then the amenity creation. And everybody has a relatively narrow bandwidth of expertise. And then that narrow bandwidth of expertise is often translated back to the service providers who are supposedly guiding the design. But there's a natural disconnect, I think, between what the service provider expects from the customer and what the customer expects from the service provider. If you don't tell the designer that what they are doing is not correct, then they think it's right. If you, as the customer, don't know why it may not be right, then you are tacitly allowing them to dictate your outcome, right? And most of the time, they don't know what's right, and they are looking to you for guidance to tell them. So immediately you have an asymmetry. And then you've got a universe that's set up where everybody's responding to capital demands. So the person who's buying the land is competing to buy land at market price. The design components are being done really to say, how can I make my product as much like the competition as possible? Because you're all responding largely to lender checklists, right? So the lender feels that the more similarity that exists between products, the safer their loan can be. And then you're going into a construction phase where you're bidding it against, let's just say, the willingness of subcontractors to do the work. And you're sort of in a competitive environment for everyone's attention. And then you're delivering into a universe that is relying upon some kind of exogenous job creation in order to create demand, right? And all of those things you are doing really with a ton of exogenous potential outcomes that can harm you. Rates can go up. Any number of things can happen. And so typically what we found is that if you're doing all of the things the way you're supposed to, you have to hope cap rates go down in order to make any money. And it feels like that's just not a very sound strategy. So we've always looked for ways to what we would describe as hack the value chain somewhere, that we need to be creating value really at every stage of the product creation cycle. And one of the ways to do that is obviously if you can find an arbitrage where you can buy an incredibly high quality physical plant, think, how do I preserve as much of it as possible? And then sort of re-demise the interior into something that's far better than you ever would have been able to create from scratch, faster and cheaper. And then the key to that, though, is that you as the customer have to know more than the people who you're hiring to do the work, because they're actually looking to you for guidance. And so it's our job, it's incumbent upon us to know each one of these decisions that we are making is either accreting or diluting value at some point along the chain. And if you think that an apartment complex is really an assemblage of 1,800 to 2,000 individual decisions, it's incumbent upon you as the creator to know how every one of those decisions may either accrete or dilute value. And I just find that the more that you have a system that's set up where people only develop very limited scopes of knowledge, it's really impossible for those kinds of organizations and teams to have sort of the breadth and scope of vision to understand how all of those things really work together in a way that can maximize the return.
That was beautifully said, Rob. And I was just recently having a conversation with a client about this, and it's a little different take, but I think it relates. And he said to me, he said, "Look, I need to know each of the roles right now. I need to understand what's happening in all parts of the business. At some point, I will have to decentralize that to a certain extent." He said, "But I really need to understand so that I can give the proper direction and the proper, I guess, overall vision for the group of people who have, like you said, these sort of siloed expertises that, flow into the one thing." And, all the while, we're trying to get him out and get him in doing his one thing. But it struck me as, yes, at the very beginning of something like this, when you're just forming a company and you really are the visionary and you are really putting the vision out there for your team, whether it's outside contractors, inside people, whatever, you really do need to know more than the group. And it sort of flies in the face of, you can't know everything. So let me ask you this: what happens if you don't have the expertise and you do need to still guide? Like, I'm sure that's happened because nobody can know everything. So how do you deal with that?
Well, I think we would advise you not to get started.
Love it. Yeah. Yeah. Tell me more. Yeah, it's good.
Because it's the real estate business is really only risk. And if you don't really understand what kinds of risk you are assuming, it's like playing with fire and you just shouldn't do it. Yeah. So that would be my recommendation. But I think obviously you have to learn somehow. And so the way that most people do it, I think the safest is they do it on somebody else's nickel. So
Yes.
if you work at a big company and you don't have to take the only risk that you're really taking is you may get fired for making a horrible mistake or doing something incorrectly. That's a much less damaging outcome than if you were doing it where you really are in a principal role and you have real skin in the game, because the risks change dramatically, and it's not really something that people should enter into lightly.
It's interesting that you say that, because it seems like every time I go out on LinkedIn, I see people that have these, very get rich quick schemes for real estate. And, early on, I knew that a lot of that, the old adage is, if you want to do well in real estate, it's going to be a long journey. As you said at the beginning of our conversation, there's nothing that's going to happen overnight. But yeah, I totally agree with you. And I think anybody that's been successful would agree with you as well. So let's talk about that road rash a little bit. I know you probably had to make some mistakes along the way. Is there one in particular that you could share with us that you learned from, and what you learned from it?
Well, it's funny. We're learning. We're in such an interesting time now that we are learning a lot of things every day that we really hadn't thought we would be learning. I think the one that I'm the most fascinated by now is, I would describe it as a misunderstanding of how people value or how people perceive risk. So to me, what we're doing is obvious, right? If you can buy a really high quality building that is better than the kinds of buildings that people have made for housing, and you can buy it for less, and you can deliver a higher quality product faster and for less money, that should be a no-brainer, right? And you would think everybody who is looking to be a prudent investor would want to do something like that, because you can spend less, get higher rents, have a better outcome than you otherwise could in any other way. And so to me, the types of risks that are intended with that are really, it's a tenant improvement process. So a lot of the sort of normative risks of construction don't exist. So for us, from a value creation perspective and from the construction risk perspective, it's dramatically simpler. When the people on the finance side are looking at it, they're like, well, if it doesn't fit into my bucket and I'm wrong, what's the risk to me, right? Because the biggest risk in the capital allocation business isn't being wrong. It's being wrong differently. And so if you make a huge mistake, or invest in something and it loses a lot of money, that isn't necessarily a bad thing. It's not good, but if you're investing in the same things that everybody else is investing in and everyone loses money, then nobody seems to be an outlier. If you are investing in something that's slightly different, and it doesn't go well, now you become potentially a pariah, because people would say, why on earth did you do that? We weren't doing it. What's interesting is that there actually isn't even that big of a reward if it goes right, because what people then might say is, well, sure, it happened to work out that one time, but what if it doesn't work out the next time? And maybe you're not able to be controlled, right? And so even succeeding in a lot of respects, succeeding differently, you could argue is worse in some respects than failing the same way. And so from a macro perspective, once again, that, the way I look at it on the value creation side is all of that is potentially good news, because it once again keeps a supermajority of the people who would otherwise be driving up the value of these assets away. And it devalues the highest quality physical plants in the best locations almost to nothing. The challenge is finding the few people who actually have the not just the economic wherewithal, but the will and the ability to sort of, let's just say, flout convention and take advantage of it.
Those are my kind of people. I just have to say, and interestingly enough, I think that you talking about this in this way is different. It just is different altogether. And so I thank you for that. So no pivotal failures so far in your entire career that would have caused you to maybe do something different the next time? Or is there something that, yes, you've done and you said, yep, I'm not going to do that again for sure?
I think right now we are being a lot more cautious about closing on assets before they are otherwise fully capitalized, just because it's just that much more difficult to put everything together. And that, that's normally how things used to be. And then just as the world evolves to changing capital times, you begin to move up the risk spectrum until such time as everything goes back to the bottom. So I think we're really now at the nascent stage of what kinds of risk should people take, and we're beginning to sort of move cautiously. I think from that perspective, we are focused a lot on how can we help other owners who've bought buildings and maybe don't know or how to maximize the value of the physical plant that they still have, and so we're focused a lot on that. But I think that's really the biggest one, is just making sure that you really have covered all the bases on your downside, so that in the event that there is upside, you can enjoy it.
Yeah, beautiful. So what's next? What are you up to next?
Well, I think as I said, we're mostly now, obviously, we're working on capitalizing 2 projects that we have here. We are looking or are in some discussions with large organizations about a much larger capital vehicle that would give us the ability to expand into other markets. What we're focused on because we're focused from a building typology standpoint on obviously buying the best assets that require the least amount of work to transition. That's what we focus on from a building perspective. From a markets perspective, we're looking to grow into other markets that have very similar characteristics to the Washington, D.C. area, which are high concentrations of information and knowledge work, very highly educated, very high compensation locations, because those were traditionally the safest office markets in the country. And now, just because of mobile telecommunications, they are the most at risk. So there's an interesting transition going on where places that combine the highest educated cohort, the highest compensation cohort, also have the most office dislocation, and they also have the highest apartment rents. So there's a really unique opportunity to dramatically grow and scale a platform, to take advantage of all of this sort of national arbitrage, which it is on. It's really an arbitrage on everything. And for the first time, you can do it in the best markets at the lowest price. So hopefully, you will be seeing us in a neighborhood near you in the very near future.
Yeah, I love that. I love the concept. And I think that it would be an amazing add to our communities where we do have buildings that are sitting with a lot of vacancy, and there's a solution for that. So I think it's just a very interesting conversation. So I want to thank you, first off, for taking the time out to share something that a lot of people, again, in my audience, maybe not be familiar with. And I'd also like them to be able to know how to get a hold of you if they want to pick your brain or talk to you more about what you're up to. So how can they find you, Rob?
Well, you can look at our website, which is madisonhighland.com. They can always call me. I'm happy to share my phone number. 678-428-6889. If you've got a building, if you've got money, if you're looking for solutions, by all means, give us a call. Or you can find me on LinkedIn. You can email me. We're not invisible.
No, you're not. And you answered my call because I was curious about what you were up to. And I appreciate that. A lot of people don't answer the phone. And so that's a whole nother podcast. But anyway, I want to thank you, Rob, so much for taking the time out today. And look for this to drop, audience, next Tuesday.
No, thank you very much. I appreciate your interest.
Thanks for tuning in to Multifamily Elevated, where we hope that you are inspired and ready to go, elevated to take on your next challenge in multifamily. So if you liked this episode, please subscribe, like, comment, and of course, share with your network. And don't forget that this was brought to you by the Multifamily Media Network, that is also sharing the latest and greatest in trends, ideas, and content across our multifamily space. Until next time, keep elevating, and we'll talk soon.